If you're dealing with a property that doesn't make financial sense anymore, whether it's the payments, condition, or a life situation, you may have heard of the term short sale. In this video, I'm going to explain what a short sale actually is and what it's not, and when it may or may not make sense. A short sale is when the property is sold for less than what's owed on it, and the lender agrees to those terms. And that's a crucial piece. This is lender approved, and it's not something that the seller can just decide to do on their own. A short sale is not a foreclosure. Foreclosure is forced. A short sale is negotiated. It's a negotiated settlement, and the lender decides the outcome. For a short sale to even be considered, three things have to line up. Number one, financial position. You owe more on the property than it can realistically be sold for. Number two, a legitimate hardship. You have to prove a real financial hardship, such as job loss, divorce, medical issues, and/or income reduction, and that must be documented. Number three, lender approval. Nothing happens without the lender approval, and the approval comes in writing. That's an approval letter with specific terms. And this is where most people underestimate the process. A short sale isn't one decision, it's multiple departments and components: loss mitigation, underwriting, investors, sometimes mortgage insurance, and they don't always communicate. And that's why short sales take time. Typically 3 to 6 months, sometimes longer. Documents expire, financials have to be, files get resubmitted. It's a process, not a single event. Lender accepts a short sale, they issue an approval letter, and that letter controls everything. It may include a required net amount, a closing deadline, and whether the remaining balance is forgiven or not. And if any of those terms aren't met, you may have to start all over again. And here's what sellers need to understand very clearly: the deficiency. The lender may forgive the remaining balance, or they may pursue a deficiency judgment. Nothing is final until it's in writing. Tax them. If the debt is forgiven, it may be considered taxable income. You need to speak to a tax professional on that. In short sales, the seller does not receive proceeds. However, sometimes the lenders may offer relocation assistance. That's not guaranteed, but it is possible. Not all short sales are the same. FHA, VA, and conventional loans, they all have different rules, timelines, and processes. That affects how the deal is structured from the start. So when does a short sale actually come into play? When you're behind on payments, or there's an approaching foreclosure, as well as financial hardship and negative equity. Compounding the issue could also include the property needs repairs that can't be addressed, divorce, probate situations, or the home is set on the market for so long that the numbers just no longer make sense. Sometimes the situation doesn't start with a short sale, it becomes one. Let's clear up a few things. Banks are not here to help you in a short sale. Banks are protecting their position. Short sales are not great deals. No, some sell pretty close to actual market value. Once approved, it's not a quick closing. Most of the time, there are still conditions to be met. Short sales are not a deal, they're not a shortcut, and they're not guaranteed. They are loss mitigation strategies driven by the lender, and they work best for sellers trying to avoid foreclosure and for buyers who understand the process. If you're dealing with a situation like this, the first step is not deciding on a short sale, it's understanding your position. Once you understand your numbers, your constraints, and your options, then you can make the right decision. Write that down. See the link down in the description, and you can start the process there. When the situation is not straightforward, the process has to be.